Samantha, thank you for joining us this morning. So I first want to get your impression so far of this earnings season, given the expectations going into it.
Well, expectations are for a bit of an earnings recession, but market doesn't seem to care. We still have this bullish backdrop, in large part since October central bank intervention, which was of size, and then the January 5th momentum rally, beginning of the year, this January effect, and then more bullish bent up buying as it related to the Fed and Treasury Bank bailout over the weekend, the infamous, March 12th backstop. So we really have this combination of, central bank liquidity and earnings have already been revised down so that companies can step over it. Plus, they have been able to raise prices and pass those prices on for the most part, which is basically, the company profits are able to withstand the inflationary impact, and consumers so far are playing along. And the dollar has basically kind of stayed out of the way. It hasn't risen. It has kind of fallen relative to other currencies, and that's a nice tailwind. So we have this central bank intervention, which is liquidity. We have, VIX suppressed and on a 16 handle now. Basically, earnings really have not much to do until we get through Apple, Bank of Apple, if you will, and if we get that disappointment. And then Fed meeting on the 3rd of May to telegraph their rate hiking path, if this is one and done. Until then, we don't really have a lot of surprises left in the market other than the debt ceiling and then, the tail risks of anything major. But otherwise, earnings are going as planned, business as usual.
And it's interesting because when you factor in the banking scare and how that made, lending conditions tighter, made the Fed's job a bit easier, you're projecting a 25 basis point hike by the Fed and then a pause. How do you position yourself in that sort of environment?
It has been very much, buy the rumor of a Fed pause or pivot and then sell the news of that. We don't have any news of that. In fact, we're entering a FOMC blackout period after this week. So there is pretty much baked into the cake a 25 basis point hike. My baseline bet is that they will pause. We've already seen the lagging effects of their hikes into financial markets. Bank crisis being one of them. And then basically the tighter lending standards have created this nice kind of backdrop, if you will, for more tightening in the market. So I don't think they need to pause anymore. And hike anymore. And if they do, I think there'll be trouble. So I personally think and have stated that I think it's one and done.
And I want to talk currencies. You mentioned Thank you. I wanted to talk currencies. You mentioned the US dollar earlier, but then also their interest was piqued by Warren Buffett's move into Japan as well. Talk about sort of the reaction from that and how investors should be looking at this.
Yeah, this was actually a really sizable, important macro move that I don't know has been really telegraphed, but Warren Buffett has already kind of made the perfect things over paper trade back in late 2020 when, shorting bonds and buying commodities was a baseline bet for a macro move, and that has played out for sure, but also buying stakes in 5 major trading houses in Japan, and then recently selling large Japanese bonds in yen. That all kind of comes together, in my interpretation anyway, as someone who is seeing the cheap rates, right, the last bastion of cheap interest rates abroad, and investment in Japan and in those companies is largely commodity-based bet. So that gives pause anyway to this very crowded trade long in FX, which is long yen. So that's been a fabulous play since the Bank of Japan intervened in markets back in September 22nd, and then again October 21st, and then again they doubled their yield curve control in December. So all of that has helped to bring the USD JPY down, and with it, the US dollar, and the 10-year yield has obviously fallen from that height in the September-October timeframe. And bringing that down has put a bid in gold and in equities. Right. So this has been a very, very bullish backdrop. But now Buffett is announcing and doing, a travel abroad to Japan, first time in a dozen years, and doing a 3-hour interview with Becky Quinn on, this is a major play for Japan. I think it's basically going to help to invite capital over to Japan. And that kind of gives me this translation that maybe this is not going to be a yen long play like so many are positioned. It'll actually cause a softening in yen. And with that, the precious metals are tied very tightly, obviously inversely to the dollar, but it should likely cause gold and silver and miners to pull back just when so many bulls are getting excited about the Q1 outperformance in gold and silver and miners. In fact, they have outperformed SPY. So I think this is actually a big move into assets in Japan that will cause others to follow and potentially could see a solid unwind of this crowded long yen trade and support the dollar.
And I know you also look at what active traders are doing. I mean, given the volatility here, have they really had opportunities to turn a profit here?
So volatility is definitely on the floor. In fact, we hit a print yesterday of $16.58. We had not seen in VIX since January 5th, 2021. What happened after that? A 35% pullback in NASDAQ. So it's just a print. We also have VIX expiration today, but it is a level of support that could start to, create some volatility as we move into more of the debt ceiling standoff. In other words, April, is typically fixed and tight trading ranges as we get closer and closer to mega cap tech earnings, Apple in particular on May 4th, which is pinned right between FOMC and non-farm payrolls, the 3rd and the 5th. Oh my. So after that, or I should say leading into that, it makes a lot of sense to have some protection tail risk. May's kind of busy. I personally have recommended to clients June. If we were to compare this to the debt ceiling standoff of 2011, the big drawdown in markets didn't come in May or June back then. It came in July. But either way, we have some absolute need, I think, for those who are managing money or managing our own to put some protection in place for that May, June, July potentiality of conflict in the debt ceiling and liquidity that has kind of left in regards to Treasury and some other kind of complicated tax day implications that we closely follow. But the point is, until earnings are kind of out of the way, we don't have a lot of events, macro event risks coming up outside of the debt ceiling. So I think volatility is very important right now, since it is so cheap to buy puts or calls and VIX. But the point is, we have a lot of risk also in the quants that have basically been buying and covering short as the market has moved higher. They're pretty much fully satiated. In other words, they are 100% full on with their SPX and NASDAQ longs, gold, not so much treasuries, they're short treasuries. But this was a lot of delta that came into the market, a lot of market structure of price insensitive buying, which also suppresses VIX. They're now at capacity pretty shortly in this 4,200 area. So I would think that's another time to also kind of tighten up those stops at 4,220. It has been my price target for a while, and look for downside, look for a pullback.
Certainly some key moments there to look out for. A big thank you there for joining us, LaDucTrading Founder Samantha LaDuc. Thank you for your time today.